Hi, listeners. It's Stephanie Ricca here with a quick note before we get started. Hotel News Now is changing its name to CoStar News, so our podcast name will change too in the coming weeks. Same smart reporting, same hosts, the great guests you've come to expect from us, just a new name that reflects our overall branding change from Hotel News Now to CoStar News. You don't have to do a thing, just keep listening and we'll take care of the rest. Thanks for sticking with us. Now let's get into today's episode. Hello and welcome to another episode of Tell Me More, a hospitality data podcast. I'm Stephanie Ricca with CoStar News, as always here with my favorite faces for radio, STR's Isaac Collazo and CoStar's Jan Freitag. Hi, guys.
Hi, Steph, I think.
Award-winning, you forgot.
Award-winning, exactly. Gold medal.
Award-winning. Yes, gold medal winning podcast, Tell Me More, a hospitality data podcast. Guys, I hate to break it to you, but summer is more than half over. We are recording this at the end of July 22. Hotel company earnings calls start this week. We've had a couple airline earnings calls. We're about to hear about the June data. I don't really know what to expect, but at this time of the summer, I always kind of feel like, have we made the most of, have we made hay while the sun shines? And I guess that goes for having vacations and having fun, but also where it goes for hotel performance, which I feel like I'm leading this into a bit of a pessimistic outlook. What do you guys think?
The sun is shining. We know that.
The sun is shining.
No,
Okay.
it's not. Where is the sun shining? I'm looking out the windows. It's been raining. I think that's the metaphor for the industry. It's been raining every freaking day here in Nashville.
Well, we just ran a story this week before, so we're recording this before hotel earnings calls begin. First one is tomorrow, July 23rd. But the preview story that we did earlier this week was kind of good, kind of silver lining. One of the analysts said, and I quote, broadly speaking, and this is about hotel public companies, broadly speaking, trends, performance, and expectations have not gotten incrementally worse over the last 90 days, which I thought was kind of good in terms of prognostication for public hotel companies and their Q2 performance.
Really?
But I don't know.
So it's like, how was the marathon? Oh, I didn't break my leg. Like, is that sort of the perspective? Things aren't getting any worse. It's like, okay, well.
Well, we know things could get worse. So I think it is a positive. They're not bad. They're just not good, right? Or not great. They're just lackluster. There's no other, I mean, it's a whole hum year, right?
I think we got to dig into that.
All right, we could do that. You want to try? Let's try.
Tell me more. Tell us more, Isaac. That's a perfect transition to talk about the June performance highlights. And you'll probably touch a little bit on, Q2 in general, maybe half year. Take it away.
Yeah, I'm going to basically half year, but June U.S. RevPAR saw its first significant decline of the year, right? So, I mean, June was really much weaker than we expected. It was down 1.2%. Weekdays weakened, and again, that's our barometer. Sometimes looking at business travel, they weakened. Group demand was also down in Q2 versus the gains in Q1. And under construction rooms are at a 20-quarter low. So that's
2020, a 20-quarter low. This is rooms in construction.
Under construction. So what did we see in June? So again, we said June RevPAR fell by 1.2%. It was mostly driven by occupancy declines, obviously. It's the largest decrease of the year, and more importantly, the largest since March 2024. RevPAR has been flat to down in 3 of the past 6 months, and all those 3 months have all been in Q2. And ADR only increased by 0.4%, so no way it could offset the occupancy declines. And it's been below the rate of inflation in all but 3 months of the past 13. So again, and this decrease at 0.4 was the biggest gap to inflation, right? Because it was only 0.4% ADR, and I think inflation came in at 2.7, if I remember correctly, for June. Funny thing is, although construction starts are slowing still, supply growth actually advanced to 0.9%. So that's the highest it's been for some time. But demand was down 0.8%. So 0.8%. So yeah, it was just a very weak month. A couple things that contributed to the weakness. We had an extra Monday and one less Saturday this year. So that's a contributor. We do know that Saturday is
Kick us while we're down, why don't you? Extra Monday.
Extra, I know, Monday. How's that? That's a good radio voice. Sorry, listeners, for I regress or digress. I'm not sure which way it is going. We also just put it in perspective some of the factors that contributed to June's softness, including the extra Saturday, but even June's TSA counts were down. Right, so screenings were down 1%, so less people flew in June than they had in previously. We also saw a decline in international inbound, which was down 6.6%. But the good news, if there's any good news when we're looking at all this, the people who fly inbound or outbound was actually only up 0.2%. So that means less people went out of the country this year. So that should be good for the industry. But again, we didn't see that. And think about this, a year ago, outbound in June was up 8.9%. So again, it was a big difference, but again, it didn't materialize in room nights. Now, there may be a reason. Room demand for shared accommodations, as measured by AirDNA, increased 2.9% in the month versus our drop in 0.8%. And I did some math as I was preparing, for many of the listeners, our hotel data conference is 2 weeks away. And so I was looking at all the stats on shared accommodations. And if you look at it on a year-to-date basis, and you combine hotel demand and shared accommodations demand to create total accommodations demand, 90% of the growth in total accommodations demand for the year has come from short-term rentals.
Wow.
So I think that's a pretty significant number. And we're continuing to dig in. Now, it's not apples to apples completely, but again, if you put it together and you look at, I think hotel rooms only grew year to date, 630,000 room nights, and most of that coming from the first part of the year. And the remainder, I think, was like 4 million or 5 million. I don't remember anymore. Jan, I gave that data to you, and I don't remember, but 4 million or 5 million room nights was an increase for shared accommodation. So a big differential. So we'll have to keep track on that. Another factor impacting the year-to-date or the June number was Las Vegas and Houston. Las Vegas, one of the things to know about Las Vegas, that the inbound is really being more impactful there than other parts of the country. So inbound was down 13.2% to Vegas. So we think that's a big number, and it's declined every month this year except January. So it's basically
twice. That's international inbound, you mean?
International inbound, right?
Into Las Vegas. Yeah, we've been talking about that.
And given where Las Vegas is, it's mostly flights, right? We know some people drive, especially international, but we think that's a good number. So we think that's a big impact. And Houston, I mentioned that it was Hurricane Beryl a year ago. There was lots of storms in the derecho. I remember those terms back from a year ago. So Houston's on a decline, not because anything's wrong with Houston per se. It's year-over-year change from the strong demand they saw last year. And then just to round out the U.S. Review, weekday occupancy has fallen in the past 4 months, with the measure underperforming weekends most of the year. So again, we're seeing, weakness, and we use that weekday number to look at, hey, is business travel returning? But it is under pressure, and we're looking at just occupancy. We're not looking at demand because obviously there's X number of weekdays versus last year. So we just look at the occupancy numbers, and they're coming down. So year to date, just to finish it up, year to date, RevPAR fell from 1.2% in May. It's now at 0.8% June year to date. So in each month, as you probably remember, we've been seeing weakness in the U.S. RevPAR numbers. So it's hard to get optimistic at this point, The reason I say that's because as we continue this year, and we especially we get into the fourth quarter, remember we're going to have a reversal of the hurricane impacts that we saw last year from Hurricane Milton and Helene. So it's very hard to get hopeful because I really thought July would be good, and we've seen the last 2 weeks have not. We haven't gotten the latest week of data, but it seems that it's going to be a struggle to do it to get optimistic. Again, it's not horrible, but it's not good or great. And then just to round this out, do you want to talk about the U.S., Jan, or let me get the global piece out?
Just to add to that, just because what Isaac and I do, we make charts, right? As part of our job is we just throw stuff
We're
on
chart
the whiteboard.
makers.
And so I made the chart where I did year to date RevPAR growth through June back to 2010. Because this year to date it's 0.8, and I was just curious, when was the last time it was that low? And the answer is it wasn't. Like this is the outside of the pandemic, so outside of 2020, 21, 22, it has never been that low year to date, right? So normally we have 5 or 6 or 8% growth in the first 6 months, and there's a couple of years, 2010 1.9%, 2019 1%, but 0.8 is unprecedented. The last time we saw it was pre 2010. So that's just another sort of framing mechanism to say, what is going on?
And also, and equally important as going to that thought is we never fully recovered yet from the pandemic, right? Either from an occupancy standpoint or from real ADR or real RevPAR. And we could be entering a downturn. Again, we don't know what this is yet on I would think, a weaker footing, because we just haven't gotten back there. And we see it in the pressure that margins have, because again, even though nominal ADR and nominal RevPAR look great, 13, 14, 19%, when you adjust it for inflation, no, it's not great. It's still below, and our owner friends are struggling with higher costs of everything.
That's what weakened the footing, when you said we never recovered back to equal footing, were all those external factors.
Right. And then just to give you just a quick update on the global, because we know we have some listeners out there globally. Global RevPAR was also slow in June, and it was down to last year. And I didn't write the number down, so I don't know what the number was. That's pretty good, Isaac. I didn't actually write the number down.
Hey, they said they rely on making charts. You can't make the chart and keep it in your brain.
Yeah, I don't keep my brain, and I don't have my Tableau open where I tell you the number. So we'll just say it was not as good as it was in May. How was that? And so, like the U.S., it was attributed to the softness was attributed to falling occupancy. ADR was up 1.4%, which is also not great. So for year to date, global is at 3.3% for June year to date, and that's all on ADR. And some of the standout countries, India was up 10.3, Japan 8.5, Latin America and the Caribbean at 7.7. And the flip side, Germany was down 18.3%. Sorry, Jan. And that's because a year ago they had the Euro 2024, as we remember. And China and Caribbean were also down by nearly 5%. I just misstate that when I should have said LATAM, LA, or Latin America, and the rest of South America was up 7.7. Caribbean was down 5%, right? So I said that included the Caribbean earlier, and it did not. That's truly is Latin America and all of South America. So those are the highlights from a performance standpoint, and I will find what the June number was for the globe. Just give me some time.
Highlights? I don't know what's so high about them, Jan.
Yeah. Are they lowlights?
They're lowlights.
So just to give you some time to dig through the data, but one other commentary, Delta came out with their second quarter earnings call, and just to sort of rattle off a couple of comments from the CEO and the head of investor relations. So Delta in the second quarter earnings call said softness largely contained to main cabin. Premium revenue grew, outpacing main cabin. Main cabin margins remained soft. Softness in Europe outbound. And then they finish on this, I guess, hopeful tone. They said, the hope is domestic is hopefully going to inflect back to positive. So read these words, hopefully going to inflect back to positive. So it's all hope is their strategy. So, but
hope is not a strategy.
Hope is not a strategy. Hopefully on a earnings call. Okay.
But the back of the bus, right? The main cabin is certainly soft for Delta. It's a bellwether. for, main cabin travel, I think, for the other airlines, which then translates probably into softer outlook for our limited service property types and scale. So yet that also doesn't help us looking forward.
And that global number, just again, was flat. If I just would have looked at my notes, flat means zero. That's why I didn't put anything. It's just literally is 0.0. And so
ladies and gentlemen, the finest analytical minds of our industry. Flat means zero.
that means a zero. But going back to that, Jan, I mean, it's really interesting because when you see, well, I've been on a lot of planes. I was traveling all last week for one of our key clients, and those flights were packed, and they were going to Orlando. And again, maybe that's just the week I was in. So it's really interesting. But what I have heard over and over from many clients as I've been traveling this summer is that August is going to be weak. And obviously, we know that's a school start. So again, as we think about great, July, maybe we eke out a positive number if things do pick up in the last 2 weeks. But August looks weak. And then we go into that fourth quarter, and we have the weakness from Hurricane Milton and Helene. Now I'm putting it together. The Hurricane Hiltons. Yeah, I don't know.
The fourth quarter demand impact because of the hurricane comp is certainly going to not make it easy, right? It's going to be very, very hard to grow that. Likely, if we just have to take a normal year, we will see demand deceleration from a year ago. Right. What is a little scary to think of is if demand actually would grow, because what that means is that we had another really impactful weather event. So I'm actually okay if the weather is a little bit more subdued and the room demand is therefore, not growing, because I think the opposite would imply something pretty bad.
And I do remind folks that if you look at it, because we still, in my presentation, I still break out things. So I break out the hurricane markets, I break out LA, greater LA, and then I break out the markets that had special events, and that includes Las Vegas. You've probably heard me talk about this before. And when you look at the middle of the country, like the remaining 17 of the top 25 markets, their demand is growing at 0.9. So we're seeing something happen in some of these big markets. That's actually pretty good. And then on the rest of the country, excluding all those other markets, it's like 0.2. So that's where some weakness is in like the main, I don't want to call it Main Street, but you're more rural, you're more suburban type markets. But I think that needs a lot more digging. And for our listeners, we will be releasing a new forecast in 2 weeks' time at the Hotel Data Conference. So you'll get our thoughts on where we think the rest of the year will be very soon.
Another interesting time period, I think, we talk about obviously June down, July not so great, hearing that August also not so great is, remember, the promise that we heard over the last 2 or so years about that summer to fall shoulder season, when summer leisure was still really hot and work from home was still very popular. And, there was a lot of good performance, like extending the summer for the last couple years. Sounds like that might no longer be interesting source of demand. What do you guys think? Is everybody going back to the office? And
we talked about this at lunch. We're still seeing more companies announce, more time in the office. So that's good. I think that is a positive. Jan and I've talked about that forever. It is a positive. But I think, again, what we're missing still, I think about this as like a hotel, like the industry as a single hotel. Hotels, when you're trying to create your demand and you're thinking about you tend to get that contract business, right? You build that foundation, so therefore you can flex your rates and everything as other demand drivers come into play. And I think that business foundation is still missing. I really do. And I've been looking for that key to show it. That's why we look at weekday, but really to understand that as an industry, we haven't gotten back. It's not 50%, so it's better than what the prediction was at the pandemic, but it's also not back to where it was. And I think that's why Jan and I talk about this all the time. You have the ebb and flow on a weekly basis, because without that foundation, we're reliant so much more on leisure, and leisure is not a 365-day business for most people. Jan being, Jan's on vacation 365 days, right? Yeah. But no, being real serious. But again, I think that's what the issue is. It's going to be, I think it's going to be an interesting remainder of the year and 18 months. I don't think it ends.
Yeah,
Well,
two quick comments on that. You just name checked Bill Gates without name checking Bill Gates, but he was the one, who said that business travel will be forever curtailed by 50%. Obviously, that was incorrect. And that's the good news is that that was wrong, but we are not quite back to where we were before. The other part is certainly something that gives us a little bit of pause. Is so the American leisure traveler, a lot of them are seeing their student loans come due. Stephanie's team has written a couple of articles about that. The loan forgiveness program under the other administration was stopped. Now people have to suddenly see, oh, my credit score is going down if I don't repay that student loan. And that was arguably money that they could have spent on vacation. And I think we're going to see that impacting how people spend.
you scared me for a second there when you said my name and paused, and I wanted to say, no, I paid mine off. I promise, unless there's something you don't know about. Because we are moving into Jan's topic of the month, and he is going to unpack some demand for us around groups. Jan, where do you see this heading? How has group demand changed to really shape this overall picture?
Yeah, so Isaac teed it up quite nicely. He talked about the weekday occupancy percent change. And we don't try to inundate our listeners with numbers, but let me just rattle off 4 numbers real quickly. For the last 4 months, the weekday occupancy percent change this is going back starting in March, minus 0.9, minus 1.4, minus 1.4, minus 2. So if you couldn't listen to that because it was too fast, there was just a lot of negative signs in that statement.
We can visualize it going down.
We saw weekday occupancy continue to decline. So I thought it would be interesting to look on the group side of things. And again, I don't want to overload this with data, but last year, for the first 6 months, we sold 47.8 million group room nights, give or take. This is mostly for the upper end, luxury upper upscale hotels. So it's a small sample set, but I think it's directionally important. We've always looked at that group piece to say, okay, is it growing? And it had been growing. That's a good indicator because that builds that base that Isaac was talking about. So last year to date, 47.8 million. This year to date, 47.8 million.
Oh,
So there is actually no growth. I mean,
Oh.
it's 60,000 rooms or so different, more in our favor this year. But 60,000, is really, for the lack of a better term, not a whole lot. Divide that by 6 months, that's 10,000 rooms a month in addition, with new group room demand generated. And we're still well below the 50 million group rooms that we sold year to date through June of 2019. So I don't like this trajectory. I always want a little bit more growth, but these very, very de minimis growth numbers, or even call that flat for all intents and purposes when you visualize it on a chart, that to me means that there is just a lot of uncertainty in the corporate environment, in the corporate group booking environment. And there was an interesting article in Politico that, and they have a slant, I get it, but they used Elliot Ferguson from the Convention Visitors Corporation over in DC, and he was making an argument about groups staying away from DC or staying away from America. And he's basically saying, look, the rhetoric from the administration has an impact. Right. And he says in Washington, even US organizations count on large numbers of foreign attendees at the gatherings. And then his quote, they basically said they're no longer considering DC or no longer considering the United States. Early in the article, there were a couple of groups that were mentioned that had pulled out. So I'm not pointing just at international inbound lacking, in the group demand numbers, but I think it is certainly one factor in the group numbers not being as positive as we had hoped at this part of the year. So group meeting season is upon us. September, October, traditionally very, very strong. So this year is not written, but where we are right now with basically flat group room demand year over year, and still 3 million, 2.5 million rooms below where we were in 2019. That to me does not bode well for the industry overall, because going back to Isaac's argument, you need that base in order then to layer in the other demand drivers in order then to have pricing power.
Can we talk a little bit about that uncertainty, like you mentioned, and we talk about this idea that, government rhetoric says America is not welcoming or so on and so forth. But I want to unpack a little bit about some of the whys behind group events, group travel, conventions, whatever, might not be happening, even if most of those attendees are US attendees, in an environment like this. Because I think sometimes sometimes we forget that, these meetings are being held by companies that are feeling pressure on their margins and their spending. And so it's, maybe not so much for them saying, "Oh, we don't like this government, we're not going to DC," but it's, "Hey, we are a giant company and there's a lot of uncertainty around how we are spending and making our money, ergo travel and sending everybody to a big conference may not be the way to go."
Yeah, I want to be very clear. This is not a political statement about the
Right.
administration rhetoric. I mean, it is obviously for Elliot Ferguson. Like, I think he clearly makes that
Sure.
connection. But I think what we have seen is the infusion of more uncertainty, right? And
Right.
we've talked about this before. Uncertainty breeds inaction. And if you're not sure how you're going to make your quarterly EBITDA or your annual
That's
EBITDA,
it.
you're going to say, you
That's
know what?
it.
What's easy to cut? Travel and training.
Mhm.
Always has, always will be. And if these large corporate events are taking place, well, we used to send 5, maybe we send 2. We used to send the whole C-suite. Maybe it's just going to be a head of investor relations and or CEO. So I definitely think that has an impact, the uncertainty about
Right.
what my bottom line will look like because of the tariff situation, that makes
That
people think about travel twice.
Exactly.
And that's what's going to add, Jan, is not only do we have uncertainty, but you also have rising costs. And so you have that uncertainty and you have all these costs rising. Yeah, you're gonna be more selective in the decisions you make, especially when it comes to travel, because it is costing more to travel. And then you don't know what the future's like. You're willing to pay the money if you think the future's bright and everything's gonna be great. But when you really don't know, it's like you got to take the conservative route. Instead of sending 5 people, we'll send 2. People are still going to meetings. There's no doubt. Everywhere I've gone, again, I've been I've been on the road for the last 2 weeks, and folks are having meetings. But I do think it's going to be a little bit more selective. And then you are losing some meeting attendees because of higher costs or because of changes, right? Where their job no longer exists. I'm thinking some of the federal employees. Again, not a big group of people who go to conventions a lot, but hey, some people do, and that's starting to get, obviously
Right.
drained a bit. So I think there's a lot of factors, but yeah, at the end of the day,
Mm-hmm.
we
And
need
sometimes we
conventions.
forget from
Yeah.
these periods of low to low, or, after we've had a prolonged period of good and high demand for a lot of that
Right.
business type travel, sometimes we forget all the factors that weigh in. Now it's time for Isaac's topic of the month. And, where there is demand or where there lacks demand, there is or is not occupancy. Isaac has been digging into occupancy recovery from so many levels and layers. What have you been uncovering lately, Isaac?
Yeah, we began this conversation years ago, right? When we first started, even 2 years ago, when we first started this podcast about occupancy hadn't recovered to the 2019 levels. And so one of our topics that we'll be again you're going to preview it for the first time here, will be at Hotel Data Conference, where we've been really digging into that and trying to understand, hey, if this is really the beginning of the downturn, what does it mean that we didn't recover? And as we said earlier today, we haven't reached the 2019 levels. We haven't reached the real RevPAR or ADR levels. So we are going to start, if this is a true downturn, on a different footing than we were before the pandemic or even before the Great Recession. So what I started looking at is I looked at the percentage of hotels 6 years after the downturn, 6 years after the Great Recession, and 6 years after the pandemic, right? Because that's June, and we're on a 12-month moving average. And I just looked at occupancy right now, and we'll go into the RevPAR side in a bit, but only 35% of hotels have recovered to their 2019 occupancy for the 12 months ending in June 2019, as compared to 46% after the Great Recession, 6 years over. And as we've been talking about weekdays, when you look at that weakness, the weakness is all squarely in luxury, upper upscale, and upscale. That's where you see recoveries in that mid 30s, about 33%. But after 6 years after the Great Recession, 60% of those hotels had recovered to their 2008 occupancy. So that's again, when I start thinking about when we're talking about that weakness in business travel, that's why I keep looking back, or even group, as Jan was talking about, that's where it's all centered, right? It's that upper tier. Even though upper tier is leading the way in our industry right now, the bifurcation, they have the highest RevPARs, not like, except for luxury, really high. But that's the weakness. And it is really in that middle tier. And then I broke it down a little bit more just to understand, first, we looked at it by tiers. We looked at how many hotels were 10 points or more below their 2019 occupancy. And that's 25% of our total industry. These are comparable hotels, I should have said. So we're looking at a huge 57,000 hotels, I think the number was when I dissected this. And then you had about 35% of hotels were between -2 and -10 in terms of versus 2019. And I think that's, so in total, if you're about 2 points off your occupancy, that's a lot of hotels, right? They're not. So I considered flat -2 to +2, and we'll have more on that -2 and below than we have in that flat category or that higher category. So as we think about our footing and thinking about where we are, as things get weaker, I think this has an ability to impact hotels more than we thought because of the higher cost of everything. And I'm thinking about margins now and EBITDA and GOP, because the base isn't there. That base is missing. And so that's a little preview of the data we're working on. And just to give you one last thing, I did a waterfall graph on RevPAR. So RevPAR at the 12 months ending June was 99.09, and right now it's 161, right? Just to give you an idea, year to date. $1.12 of that increase actually came from hotels that we didn't consider comparable in my analysis. And by not being comparable, that means they were not open 2019.
Okay.
And they've opened sometime after 2019, or for some reason they didn't report data for whatever, but we didn't have data. And then another 88 cents of that increase from 99 to 100 came from hotels that actually did recover, that actually have a higher occupancy today than they did in 2019. Everything else was pretty nominal or a drag on our on the industry's RevPAR. So again, a lot of great data here. As Jan and I've been talking about this, I'm not sure what we're going to do with all this, but it continues to highlight. I mean, there's a lot more slides we could go through, but that's for another day and time. But it just keeps telling me that that foundation is missing. We don't think whatever is going to happen going forward will be as bad as the pandemic. So we know it's not going to be that. We're not even sure it's going to be as bad as the Great Recession. But the point being is we are starting at a weaker footing because we're at lower occupancies, and we never got to the ADR or RevPAR levels on an inflation adjusted basis that we needed to shore up margins. So that's the work I've been working on. I don't know if it resonates, but that's quick insights.
Jan, does it resonate with you, and how? In what way?
Well, the two numbers that resonated with me were, number one, you mentioned that around 60% or so of properties after the great financial crisis of the Great Recession got back to their occupancy after, call it 6 years or so.
Yeah,
like 2014.
Luxury, upper upscale and up, yes.
Okay.
And today that number is much, much lower.
It's half of that.
It's half of that, right? That is, I mean, we talk about cyclicality in our industry. And to me, when I just think about the waviness of our, because it's cyclical, like the waviness of our supply and demand data specifically, or ADR data, I always think, oh, we're going to come back to where we were. But if only a third of the properties got back to their occupancy of 2019 compared to the prior upturn where it was 60%, there's something not quite right there. I mean, it is, the data, of course, is correct, but I'm looking at this as an analyst, I'm saying, wow, those new hotels really, that new competition really ate into their ability to recover. And as we also know, room demand has not fully recovered. So that connection between new supply and demand not being fully back really hit the occupancy. And I just think it's just a stark number, 60 versus 30.
Mm-hmm. And it makes you wonder too, when you said, I mean, that period you looked at sort of a 6-year span of same store, like the same hotel. So at what point did any of those hotels get renovated, go through a PIP, go through something that would give them some sort of demand or occupancy boost?
Right. And the other thing I think about, so all this data has really highlighted another idea that I have in my head, which is not contradicting, but just different from what I just talked about. 2019, 2018, even 2017 saw extraordinary occupancy, right? It was 66% at the end of 2019, if I remember correctly, for the US. But if you look back all the way to 88, since we started taking data, those are anomalies. Those are not, those are extraordinary years. And so the other thought I have in my head, given all the alternative accommodations, not only and alternative experiences, forget that, because I'm thinking now cruises, maybe we never get back to 66%. Maybe that was an anomaly, and maybe that
wasn't the norm. That was the outlier.
Mm-hmm. And maybe the benchmark of trying to get back to 2019 from an occupancy perspective, maybe that's wrong, but what should it be? And that's a whole different question for a whole different time.
Oh, Isaac, do you sleep at night? Don't we just picture him like sitting bolt upright in the middle of the night saying, but what about if the prior peak was not
Ask
really...
my therapist. He's right there. Hey, Jan, what do you think?
But of course, the industry, work, the participants that we meet at the industry conferences, everybody looks back at the prior peak and says, hey, my owners want those numbers. Let's look back at 2019. It's going to be a very, very tough conversation to say, actually, let's compare ourselves to 2017, because you sort of gravitate. I think that's human nature to go back to the prior peak. But the argument that Isaac's making here, I think, is very, very valuable. And I think for all the revenue managers out there, is to really understand, was your prior peak the prior peak, or was it just a very positive outlier because of a confluence of a whole lot of forces that may never happen again?
Lightning may not strike twice, although there are repeat gold medal winners in back-to-back Olympics. I mean,
and in podcasting.
And in podcasting, I mean, I will expect us to surpass prior peak, so it can happen.
Fingers crossed. Let's go with the Delta. We have hope.
But then we said hope is not a strategy. No, we're going to keep up. Maybe hope can be a strategy. All right, guys, I've got to say, this has been a little bit of a Debbie Downer of an episode. So I would love if we could end perhaps on a bit of a high note in which you share your metaphors for industry performance right now. What do you think? Will you do that for me, Jan? Maybe?
Well, okay, I can talk about the sun. Is that helpful?
Please. Here comes the sun. Here comes the sun.
Little darling, here comes the sun. So we went on our family summer vacation, talk about tying it back to your initial commentary.
Look at you traveling. Yes, excellent. Exactly. In the summer. So, internationally,
we did. And currency we went to Iceland. Exactly. Currency be damned. But Iceland turns out is close to the Arctic Circle. What makes the Arctic Circle special is that if you go further north than that, the sun never sets. Or over December and November, the sun never comes up. So we were right there in late June, early July, and the sun technically set at 11:45 p.m. and technically rose at 2:30 a.m. But let's be clear, it was the midnight sun. Like, it never got dark. And so that's a little bit of my metaphor for the U.S. hotel industry right now, because you keep saying, is this over? Is this over? And you keep looking at the data and you're looking at the sky and the sun is still out. And then you just try to turn over and you're like trying to get some sleep, some sleep time, and it's just not happening. So the metaphor for me is that we keep looking and it's just not getting better. So hopefully, eventually the sun's going to set. Hopefully, eventually we're going to go back to normal.
But hey, it's not fully dark. It's not April 2021, which I would say is the full-on blackout curtain of darkness, right? So maybe look at it, maybe look at it the other way.
Yeah. And by the way, if you have a chance, put Copenhagen and Reykjavik on your travel map. We came back because Nashville is an international big town now. We have a nonstop flight from Reykjavik on Iceland Air to Nashville, Tennessee. And that was a joy to just go to one passport control here in Nashville. But Copenhagen was super fun with our boys. And Reykjavik and Iceland were just, I mean, it's truly out of this world. I learned that the American lunar program did their test walks and test drives in Iceland because it is such a lunar landscape. So if you have a chance, it's super interesting to go.
Did you have reindeer hot dogs?
We had I think they were sheep hot dogs. But
okay, I've heard that hot dogs are quite the...
Hot dogs are a thing. So
quite
there's
the
this
thing
tiny little, and we'll put the link into the show notes, this tiny little hut that at 9:30 p.m. in the midnight sun, but there was like a line of 50 influencers who are all looking to take a picture of their hot dog. And so we just, of course, got in line and got one too.
Yes.
It was very nice.
If there's a line, just join it.
Just join it.
For more travel trips, contact Jan at janaway.com. That's janaway.com.
Sponsors of this episode of Tell Me More, Hospitality Data Podcast.
Okay.
Isaac, come on. Close us out on a good note, please.
Well, I have two songs, and I'm going to go for my second one. But today is a sad day, as we're recording this. We just heard that Ozzy Osbourne passed away, right? And so I thought about No More Tears as my metaphor, right? But I'm also thinking there's a new song by the Black Keys called On Repeat. And I like this song because I think the next several months, RevPAR will be on repeat. I don't think it's going to change very much. Darkness when you left me, darkness like when you left me, when you stopped being positive, heartache since you've been away. I can't seem to make a change. Tell me why I can't. I can't stop thinking about you. I'm thinking about you. And I will continue thinking about RevPAR and everything else in the drive because I cannot stop thinking about it.
And this is why Isaac stays awake all night. Oh,
seriously.
You know what? The course of true love never did run smooth, right? Something like that. I'll call that optimism.
Let's go with that.
We will go with that. And you know what? Hope can be a strategy. And that does it for this episode. Remember, if you are coming to the Hotel Data Conference, August 6th through 8th in Nashville, you will see us live on stage once again, where I promise that madcap hijinks will ensue as they always do. And guys, I hate to break it to you, but my request for a Tell Me More t-shirt cannon was denied. So you're just going to have to bring the data. And even if you won't catch us live on the road this time, we will be back, of course, with another episode next month. And as usual, find all of our news at costar.com/hotel news. Thanks, guys.
Thank you.
See you at HEC.
Hi, I'm Davon Reed.
I'm Omari Head.
And I'm Chris Henry.
We're the hosts of the Next Gen in Lodging podcast. It's a monthly show in which we interview a new generation of hoteliers to get their insights into a variety of disciplines and topics, from finance to food and beverage and hotel operations. Listen to us on Spotify, Google, Apple Podcasts, or wherever you get your podcasts.
This episode of Tell Me More, a Hospitality Data Podcast, was recorded on July 22nd, 2025 by me, Stephanie Ricca. The episode was edited by Rachel Daub.
Find all hotel industry news at costar.com/hotel news. Thanks for listening.